All right, let's go ahead and get started. It's roughly 6 minutes after the hour. Welcome everyone to this edition of the Louisville Real Estate Investor Meetup Group. For those of you guys who are new to the group, we do meet on a bi-weekly basis. And since COVID, we've just been trying to engage with speakers all across the country. And recently we reached out to Scott, who was so gracious enough to come and share his time with us and really answer some of the pertinent questions we had regarding just everything related to real estate. I will say that he's also the author of this book, Set for Life, which is a book that I've recommended and I've probably bought for 5 or 6 people. So you probably have like 5 or 6 reads from me. I know actually Jake Guy on this.
Oh, I think we lost you, but it sounds like I owe you a beer.
Well, Raphael, you there? Oh, there you are.
What? Oh, can you hear me?
Now we can. Yeah.
Oh, okay. Sorry. For some reason I lost you guys, but yes, it's just an awesome book and I'm really excited to kind of, I did. And yeah, just kind of go along the way. But I guess to start out, what we usually do with our speakers is just kind of ask a little bit about themselves. So can you tell us a little bit about yourself and what got you interested in real estate and what you're doing now?
Sure. Maybe my kind of backstory or how I started my career would be helpful in context of this question. So I started my career in 2013 in August at a Fortune 500 company as a financial analyst. And within a couple of months realized that, hey, my career progression will look like this. I'll go from financial analyst 1 to financial analyst 2 to senior financial analyst to finance manager to senior finance manager to finance director to senior finance director to vice president of finance to senior vice president of finance to CFO. And if things go really, really well over the course of 20, 25 years. And so that was not like, once I kind of internalized that was not very appealing to me. And I quickly kind of began to think like, what else is out there? And just kind of began stumbling about career building, wealth building, that kind of stuff. And at some point in those first 3 months of my career, discovered the concept of financial independence or financial freedom generally. And in that, I probably first stumbled across or first really internalized the Mr. Money Mustache blog and that approach to financial independence by, which really kind of talked about being frugal, spending very little, and then generating passive income through stock market or index fund investing, although he did have some forays into other assets. But around that same time, I also discovered the concept of real estate investing with BiggerPockets. And so I kind of tried to merge this frugal mentality around approaching financial freedom with a real estate investing spin. And what really clicked for me is at some point in early 2014, 6, 7, 8 months into this journey, I read Brandon Turner's article, How to Hack Your Housing and Get Paid to Live for Free, where he talks about you buy a quadplex, you rent out the other 3 units, they pay your mortgage, and boom, you're good to go. And so that was like, okay, lights out. That's the move, because if you want to become financially free, one of your biggest expenses is housing. And that wipes it out. And so now how much easier is it to save? How much less how much less passive income do you need to be financially free? So fast forwarding through kind of 2014, and in July, I kind of make 2 decisions. One, because of my frugality, I've been able to accumulate 15, 20, 25 grand. And I make 2 big moves in the last 6 months of 2014. One, I buy a house hack, a duplex that I move into, rent out the other unit, have a roommate in the other half. And then the other big move was I changed jobs and joined this tiny little startup called BiggerPockets, of which I was a fan of their podcast prior to that. Both of those options or maneuvers were made possible, I firmly believe, because I was so cheap or frugal, whatever you want to call it, in that first year, had some cash and, felt that I could take a risk in my job and make this move with that. And so that was really that was from the zero net worth to the first couple of big moves in that first year. And then, the next fast forwarding through that next 6, 7 years to the present, I was able to, expand my savings rate because I'm not paying for housing. I joined this startup and I'm head of sales, and that's enabling me to scale my income pretty dramatically because we're, I don't know if you've heard of BiggerPockets, but we're growing pretty quickly over the last couple of years. And eventually I take on more and more operational responsibility at the company. My income continues to grow. I find myself, president and then CEO of the company as we bring on some private equity sponsors and continue to build the brand and the business. And then I also buying more properties along the way, investing in stocks and those types of things. But that was kind of that really the beginning of the flywheel, I guess, that's been my career over the last 6-7 years, was that first year and that little setup. How's that for a long-winded answer to your question?
Oh, it was a great response. And I did a little. I mean, again, a lot of this stuff is available through BiggerPockets, so I've been able to learn a little bit about your background, and you do talk about it in your book as well. So it is quite interesting. Luke, did you have?
Yeah. So the frugality thing, that's kind of one of the things that I really like about what you talk about. And I think perhaps the most important part of starting your journey, if you're trying to figure out how to do this whole thing. Just to give you a quick background on me, I was a public school teacher, so I didn't make any money when I started, and basically just kind of was frugal and trying to save as much as I could. And that's kind of how I got going as well. But as far as the mindset that you have of frugality, what types of things do you think are the most important to keep in mind when you're starting out, when you're trying to figure out areas to maybe cut, or what you should and shouldn't spend money on, to try to maximize your savings rate in the beginning?
Yeah. Can I whiteboard?
Of course.
All right. Yeah. So, look, when you make a pie chart of American household spending, look at my beautiful pie chart here. A third of it is going to be housing, right? Another 17%, this is going to be 33%. Wow. Look at that handwriting. Another 17% is going to be transportation. All right. We'll just go there. 13% is going to be food. Then you've got insurance, pensions, and everything else. And I'm probably moving a little bit, not to scale with any of this stuff. So like what most people do when they try to start being frugal is they're like, oh, I'm going to cut out my latte budget, which is this tiny little sliver on the upper right corner, and my movie budget and my beer budget. And, as a 23-year-old, my beer budget is really, really important to me. And so that doesn't sound very fun or like an effective way to build wealth. But the answer is, if you do some basic analysis, this is the meat of your budget. So you've got to figure out a way to, if you want to become free, if you want to in a timely manner, and you don't have an option to earn income or build an asset or some of the other ways to build wealth available to you, if it's got to be spending, then the answer has got to be clear. It has to be done in the housing and transportation section. And so what you do is you find a way to live cheaply in an apartment with a roommate or whatever you got to do, share housing for a year or two in order to cut that expense and get it low, and then consider that house hack. And that's how you get that expense out. This is, if you're starting from this is how I approached it, at least. And the other part here is, how do I get my car paid off and be kind of an economy vehicle, typically bike to work? And then this is not something I had at the time, but if you can layer in what's called travel rewards, like credit card hacking and that kind of stuff, that can enable you, when you do have to fly, to do that at really low cost or for free. And then this is just a set of responsible decisions around daily eating. This is not saying like, don't go out for chicken wings with the buddies. It's saying don't order Chinese food on the way home when you can make yourself a perfectly appropriate, healthy dinner. So my mentality for frugality is getting those big things right so that I can drop that 20, 50, $100 in the fun stuff when that comes up, because that's what life is all about.
Yeah, absolutely. That's the one thing I think what you're going to get a lot of people to kick back on that is, if because this is what I hear from people, they got kids or whatever and they can't do the house hack or they can't do whatever, and that's one of the big objections. And I hear it, but at the same time, you got to do it one way or the other, right?
So, well, yeah, there's only 4 ways to build wealth, right? You can spend less, you can earn more, you can create assets from scratch, or you can invest your accumulated capital. So unfortunately, those rules do not change based on whether you have kids or not. So there's an advantage to getting started before. But if you do have kids, then, and you're not willing to do some of those things that I just mapped out or attack those line items in the same way I did, just know like, hey, you can still build wealth. You just may not be able to go as quickly in that particular area, and you might have to double down in another area or whatever. So, the laws, the rules, the fundamentals don't change, but that doesn't mean it's hopeless. It just means that it might be a slightly different rate of progress or a different method used to build wealth.
Yeah. And I think that's really important for people to realize, if they do have obstacles, like there's an answer for every single obstacle that you could get past it, because people get caught up sometimes and then don't try.
I was just on the phone with a guy yesterday, And this dude had like $20,000 in debt, has a kid, has a criminal background. I won't go into any specific details beyond that, but was able to pay off $18,000 in the last year and a half, making $15 an hour while work, but with overtime, that was part of that was able to expand his income, with sales opportunities that were presented to him and all that kind of stuff through his job, but with that hustle. And so there's this individual was very interested in the idea of a house hack and that kind of stuff. So it just depends on where your life situation is and what you want and where you're going. So that's not to say it's for everyone. It's not not everyone's going to house hack. Like that's just not how it works. But that's how I approached it and how I thought about frugality personally.
Yeah. I love it, man. I love it. I think everybody should think like that, but you can't get everybody on the same page. And there's, that's a great way to do it, though.
No, I 100% agree. And again, even if you don't necessarily think house hacking is right for you, I mean, there's still two other parts of the equation, transportation and food. So if you have an option to be able to move maybe closer to work or, closer to an area where you don't necessarily have to utilize a car, or maybe you can utilize public transportation or walk or bike. I mean, that can also help you on that front as well. So just because house hacking may not be an option, quote unquote, for you because you feel like you have a family and you don't want to necessarily be next to your tenants. I mean, again, there's other parts of the equation. So that's
absolutely.
Awesome. That's awesome. All right. So once, and I really appreciate the way you structure this book, because you start off where you say, okay, we're going to talk about the first $25,000, which is most of the time the most difficult to acquire. Then you start, like you said, hitting that flywheel where everything starts kind of going into place. So if you can, I guess, talk to me about during that first time period of that $25,000, once you save some money, can you explain what the most efficient way to allocate those funds are? So, if let's say you have some debt or whatever else, how would you recommend someone to kind of approach that problem?
Yeah, I think it depends on the debt and it depends on the person, right? So and let's not forget that if you have debt, the primary driver of how quickly you get out of debt is your accumulation rate, not your application of that debt to the debts themselves. That doesn't mean there's a right answer. There probably is, and we'll talk about that. But it's really about getting motivated and making the monthly cash flow number as large as humanly possible, and then applying that. Even if you apply it inefficiently, it probably is a matter of weeks that will change your trajectory in getting out of debt, not years. That said, you have two basic approaches. One is the snowball approach, where you attack the smallest debt balance first, and the second is the avalanche approach, where you attack the largest interest rate first. So, there's no right answer there. I think it'll be a mix for various people. But supposing I had a $15,000 debt at 10% interest, a $10,000 debt at 7.5% interest, and a $5,000 debt at 5% interest. With the snowball method, I'd attack the 5% $5,000 debt first because it would feel good to knock that out. With the avalanche one, I would attack the 10% debt at $15,000 balance first. It will take me a long time to pay it off, but I'll technically pay less interest over time. So there's the outcome of that is if you have a large enough savings rate, you're talking about a small stakes decision relative to the decision to actually make the substantial changes on your lifestyle front and accumulate that cash in a hefty way. From there, though, it's all about, like, let's suppose you don't have any debt. For me, it's all about the freedom quotient. Like I call it financial runway. But I think it's about how long you can survive without the need for a paycheck. And the trap that I think a lot of middle-class Americans fall into is they build almost all of their wealth in their home equity and their retirement accounts. We're doing this new thing on the BiggerPockets Money Show podcast where we review people's finances, and we literally have millionaires come on the show and they're trapped. They have like $10,000 in savings, make well into the six figures per year, but they have no cash liquidity with which to invest in real estate. And so the trap that you fall into if you do that, especially if you're interested in real estate investing, is you're like, oh, I have $1 million on paper, but all of that, I have 600,000 in my retirement account and 400,000 in my home equity, or 300,000 in my home equity, and then a smattering of other things that are not really cash, and 10,000 in cash, right? So I'm technically a millionaire. What I'm going to do is I'm going to get a HELOC on my property and use that to buy a rental. The problem is you're borrowing with short-term debt to finance a long-term investment. So your HELOC, yes, technically it's a 3% interest rate and you're arbitraging that spread maybe for a higher return in this property, but you're running into a cash flow situation where you're actually getting more frustrated on a month-to-month basis in terms of your accumulation, because your HELOC has to be repaid and you've got to pay, that back on in a 3 to 5 year term, typically is how people are going to think about that, rather than a 30-year term. So for me, anyways, I got really carried away there, but zooming back to our discussion, I think that it's key to not just dump all that money into a retirement account. It's good to take a match or those kinds of things. But I think that for me, the goal was, how do I accumulate some liquidity outside of home equity, outside of retirement accounts, so that I can bet on myself and give myself those opportunities? It's hard to take a job at a 2-person startup, I think, if you're in that position of being a millionaire with 10,000 in the bank and you're going to run out of cash in 2 months at your 8,000 a month lifestyle, right? It's very easy when you have a low cost lifestyle and 25 grand in the bank, even if you don't have that in the retirement account. So at least starting out, or I think at some point in life, it's good to have that runway so you can take that risk today rather than solely in the retirement accounts and home equity. So look, there's a lot of moving parts to that. It's an art. There's no perfect thing here. There's no way to mathematically put this into an Excel spreadsheet, but I just think it's important to, in my opinion, focus on that 6 to 12 month emergency reserve runway, after tax available liquidity. And I think that doing that even at the expense of some retirement stuff or buying that first home can be to your great advantage over the course of a career, because it just frees you to make those decisions on an ongoing basis. That particular rant is now over.
No, but it's so important what you just said, and I think that it's so crucial that you guys understand this, and it's actually what afforded me the opportunity to transition from what I was doing prior to this. I mean, I was in software before. I knew it wasn't what I wanted to do forever. I actually read your book, actually bought a fourplex, house hacked, leveraged that to generate a lot of income and then save a ton, and then it allowed me the opportunity to transition into, now I'm in a sales role, commercial real estate. Takes a long time to build up a clientele and eventually grow my income. But really, that's what afforded me the opportunity to do it. If I didn't have the fourplex, if I didn't have the opportunity to cut out that biggest expense, I wouldn't have felt comfortable enough to take that risk. So I think it's really important what you said, because again, especially when you have a family and all these other things in play, I think it's just crucial. I think it's very important what you just said. So I just kind of wanted to.
Here's another hard reality that tacks on to that. I think, suppose you make 100 grand and after tax, and you spend 90 a year, right? On that, your emergency reserve needs to be 100 grand, right? Because that's one, if you want a year long of emergency reserve, right? And you're going to accumulate that, over the course of 10 years, right? But if you instead have let's say you spend 50 grand on that same income, right? Now you're going to accumulate that entire emergency reserve in 1 year. And I'd argue you need less of an emergency reserve. You don't need, because your cash flow is so much higher on a month-to-month basis and your spread is so much higher, you could probably get away with a 6 months emergency reserve and have more freedom than the person with $100,000 emergency reserve. So it's a compounding effect that and look, you don't have to cut on the expense side, but you have to grow on the income side or cut on the expense side in order to get there, in order to begin moving in a timely manner out of this rat race that we all are hoping to escape. So I think that's like another kind of just gut punch to folks in that kind of situation, because it's hard to maneuver down from that high level of spending at any point in time.
Yeah, for sure. So one of the things you talked about just a minute ago was about the equity line issue. And I totally get what you're coming from and agree with you. The caveat, I guess the other side of the coin with that, I think, is if you can find a well under market value property that you're going to refinance later and then pay off your equity line, which I've done before. But that brings me to my next question. I'm sure there's a lot of people out there that have done that as well. Is you talk a lot about putting yourself in a position to get lucky when you're investing in real estate or when you're in your career or whatnot. Could you talk a little bit about that concept that you have? Because I think that's big for.
Yeah, well, just going back to your home equity line of credit, like 100%. If you're buying a property for 100 grand, it's worth 125. You could resell it immediately. Then that's a great use of a home equity line. Right. The problem is that's not what a lot of people do. A lot of people are like, oh, I think I'm going to get a good deal on my first deal, because the only, like, they don't have any cash. So it's by definition, a lot of the first deals that people are using or second deals that they're doing. That's not when you're likely to get a fantastic deal in real estate investing. You're likely to get a fantastic deal in your second, third, fourth, fifth shot, not on your first, second shot, right? I said second twice, so you choose which category you want to put that in, if you're listening. But I think that the reality of the situation is that you're probably buying an average deal. And remember that, like, when you buy a deal for $100,000, if you turn around and sell it, you're immediately going to incur 7-8% closing costs. So your equity is already compressed. So you got to be buying quite the steal in order for it to make sense to buy with your home equity line of credit. Just to be clear there, right? Now, the guy who's going to get lucky, I think, in doing that is the person who knows exactly what their good deal is and is ready, willing, and able to purchase it. And so if that's you and you want to use a home equity line of credit, from a rental property or your home, and you know exactly what that good deal is, and you just have a reactionary, like my approach to real estate investing is I go fishing. I don't go like hunting, I guess, if that's, I'm using a bad analogy. I don't really hunt or fish personally. So I'll probably butcher this, but I look at the market and I say, what is every property that's sold in the last 180 days in my market that I'm interested in buying? And I keep narrowing that pool down until I've got 5 to 10 properties that have sold. I don't even look at active listings yet, right? Because if you look at active listings, you just get depressed. But if I look at the sold listings, I'm seeing this is the actual value of those properties. Now you have to adjust, like, you can't do this when COVID hits because you have to reset, right? And the market just reset at that point. So this wasn't true in May because you can't do this research. But so sitting now, I think you can look at the market and say, okay, these 10 properties, duplexes around this type of, this year built, this style, this many beds and baths, whatever, that's 10 of them have sold at this $300,000 price point in this area in the last 180 days. That means that one property is coming on the market every 18 days, right? So that means that if I look at the market at any given time, I'm not going to see any listings that meet my criteria. Instead, I have to set up a drip or a cert. And this is on market deals. There's a whole bunch of off market stuff that I don't do. And you should probably ask somebody else about, because I'm not the expert on that. I invest while working a full-time job and don't do all these marketing campaigns. But anyways, so these are on market deals. That means that once every 2.5 weeks, every 18 days, a property on average will come in. That's one that I would buy, that I've defined as a good deal ahead of time. And then I pounce. Right. Then I have my offer ready. I have I'm pre-qualified, pre-approved. I'm ready to go, and I offer instantaneously. And then if I win, great. If I lose, I go back and sit around for a couple of weeks until the next property comes on the market. And so that's how I know or feel very confident personally that I'm getting a good deal. I think it's a highly repeatable process. You're not making an instantaneous decision. You're making a cool, calm, and collected decision months in advance, maybe, or weeks in advance, and then you're just hooking the line, right? Is that the right phrase for your fishermen out there? When you get a bite, or when you get a property. So that's I don't know. So you go back to your question was about luck, right? Yeah. Am I lucky when I get a good deal, or am I prepared, right? Am I putting myself in position to get that best deal in the market, or one of the best 10 deals in the market, according to me, over the last 90 to 180 days? I don't know. I just think that that's a lot harder to do with a HELOC, navigating your all that kind of stuff. I think you're going to need more time or reaction and all that kind of stuff. And look, that's a bad example. I'm sure you can pull that off. But again, you got to get a heck of a good deal for it to work on that. And I think you're setting yourself up for, if it doesn't work out, you're now saddled with short-term debt leveraged against a long-term investment, 100% leveraged effectively. Yeah. And your cash flow situation is going to be tough for a couple of years if things don't go really, really well. Yeah. Well, and I like how you said, because real estate's all about timing. And essentially, if you want to find good deals, you have to always be looking, right? And then that's kind of what you're saying. You set your hook's out there, and you're just waiting for the right house to come along and bite it, right? So I get your fishing. We butchered this fishing analogy, but yeah, we got it. The point. I hear it though, man. I get it.
What was it? Who was the golfer? Arnold Palmer. He said, the more I prepare, the luckier I get. So I think the logic there is just get ready on the front end, have all your ducks in a row, and then when opportunity presents itself, you'll be in a much better position to pounce.
Yeah, that's a great
so
quote.
Yeah, so I think you just need to be prepared. Like you said, create your process, get pre-approved, cross all your T's, dot all your I's, and just wait, and set up the systems. And I know we actually had Craig Curlop on a while back, and he was talking about how you're a big process guy. So it seems like that's something you're interested in as well. So great. So as far as, this is an interesting concept in the book that you wrote, and also in various other books that I've read, primarily Kiyosaki, where he talks about the difference between assets and false assets. Do you kind of want to elaborate a little bit on that? I think that would be helpful for some people.
Yeah, he calls them assets and liabilities, and he's like, let's not pretend like I'm anywhere. I didn't invent any of that. That guy really, I think, set the tone when it comes to describing those types of things. I just have a little spin on it where I think of assets and false assets rather than just assets and liabilities. And a false asset to me, I think, is, Robert Kiyosaki says asset is something that puts money into your pocket every month, and a liability takes money out of your pocket every month. So middle class will buy cars and personal residences and those types of things and finance them. And every month that takes money out of your pocket, right? To me, that's also clearly a false asset. But I also think that false assets are things like home equity, which is similar to liability. But I also would include retirement accounts in that, because my book specifically is about how to achieve early financial independence. And when I wrote it, I was 26, 27 at the time, and 65 is multiple lifetimes away, right? So having wealth in a retirement account is not enabling me to live the 40 next years, which I believed to be my highest potential years, without having access to that liquidity to bet on myself or build those things. So in that context, in the context of early financial freedom, retirement accounts can be false assets if they're not going to be leveraged to sustain permanent financial independence in the interim period between the time you leave wage-paying work and then reach traditional retirement age. Other false assets are things that will not necessarily both accrete in value and or produce cash flow in excess of inflation. So for example, I would call gold a false asset. I will piss off half the people calling in by calling Bitcoin a false asset. Not because I don't believe it may accrete in value or that it's not an inflation hedge. It's a currency like gold, like the euro, that kind of stuff. And it may replace other currencies downstream. It's just, to build long-term wealth, you're going to need cash flow or something that you can spend on a thing, not a store of value like a currency or gold or Bitcoin or something like that. So anyways, that's where I kind of draw the line. Is an asset has to both accrete in value and produce cash flow, or it has to accrete in value with the intention of you selling it and capitalizing on that to fund your lifestyle or an endeavor that you're going to be interested in undertaking.
That's a good I appreciate the clarification, because again, there's various different people talking about different assets versus non-assets. So I think having that clarification is a value for sure.
Yeah, don't lose your Bitcoin password either. If you do invest in Bitcoin. I saw an article about that. Like 20% of people have lost their Bitcoin passwords. So, gone forever.
One thing you just mentioned about the retirement account, I think there's a lot of people out there. And obviously it depends on who you are and what your purposes are for it and what your end goal is. You bring up a really good point though of financial independence when you're young. That doesn't serve you now. So as a teacher, I had a retirement account that they forced me to get forever. And then when I ended up quitting my job, I wasn't sure what I was going to do with it initially. And then I realized I'm going to try to do a self-directed IRA type thing and invest that in the real estate. And a lot of people do that and have a lot of success. But what I found was if I could just invest that into real estate, like cash it out, invest it into real estate, and then provide more cash flow, that might be better for me short term. And with the idea that long term, you might be more financially independent because of cash flow with rentals and all the rest of the stuff that you have and your assets that you have. But with that, I guess one of the questions I wanted to ask you, you said you just done a refinance with today's market, talking about Kiyosaki. I know Kiyosaki, he is a big gold and Bitcoin guy, which I know, one of the things I think is most important is you have to listen to the people out there, take in what you like, push away what you don't like, right? And for everybody, it's not going to be the same answer. But but I guess how would I want to word this question here? With today's economy and everything that's going on, you think is your mindset that as long as the asset produces cash flow, that purchasing assets right now, real estate assets specifically that provide cash flow, is still a good move in today's world?
Let me be clear here. I actually own a little bit of Bitcoin. But I don't own it as an investment, right? Here's my liquidity position, right?
Gotcha.
And I think the dollar is going to lose value. I don't see how a reasonable person can say that inflation is not going to happen over the next couple of years unless drastic action happens, in which case we're going to have a great buying opportunity in the real estate market if inflation does not occur over the next 10 years, right? So what do you do? If you have a liquidity reserve and you're going to maintain that liquidity reserve for a long time, I spread that across most of it's in dollars. But I also have a little bit in cash and gold and a little bit in Bitcoin, not as investments, as inflation hedges, right? And part of that. That's not my wealth building strategy. I'm not going to live off the dividends of gold or Bitcoin, right?
Right.
But
exactly.
that's how I think about that from that perspective. Because am I going to just sit on a big pile of dollars and let them just reduce in value? No, that doesn't make any sense. I'm going to have enough where I'm not going to be exposed to volatility risks and all these other areas, but I do like having a big reserve. And if I'm going to have a big reserve, I might as well spread that across a couple of currencies, not just dollars, if that makes any sense. Okay. So then when it comes to real estate, so what has happened recently in real estate, in my view, and I don't know, in the long run, this is not a good thing for real estate, but in the short run, the biggest lever that the government can pull is going to be interest rates. And when it comes to real estate, the payment matters more than the price. That matters more when it comes to homeowners, and it matters more when it comes to landlording, or it should, because that's your cash flow. So when interest rates fall, when an interest rate falls from 10 to 9, right? And I'm going to butcher this, but it's about 10%. It's when it falls, but it goes from 10% to 9%, you get a certain amount of leverage on that. Properties become that much more affordable with the lower interest rates. When interest rates lower from 4 to 3, you get way more leverage, right? That's a much bigger percentage decline in interest rates, right? And so what I think has happened here is interest rates just fell. The market kind of was stalling. Prices still climbed, and people were like, what the heck's going on? But I wonder if 2021 is going to see bigger appreciation, because people are going to catch on to that and begin and go to town buying after a year of uncertainty with all that kind of stuff. So what does that mean in 5 years, 10 years, when interest rates begin to climb? I think prices are going to correct, and we're going to have those challenges. And so how do you balance that in general? Well, this is where I go back to my long-term philosophy. I can predict that all day long, and I could be completely wrong. So if you invest according to that belief, that's on you. I'm not saying go ahead and bet on prices skyrocketing this year because interest rates fell down. I'm saying that I'm trying to invest on a reasonably dollar cost average cadence style in real estate, where I buy a property every year and a half, and I build that portfolio. Now I skipped 2 years. I should have bought real estate, but I just got so overwhelmed learning the ropes of this president and CEO role that I just felt like I didn't have time to operationalize the business. I spent the last 6 months hiring a property manager, getting those things locked and loaded, upgrading, rehabbing a property, refinancing, and now I'm sitting. But I'm just going to go back to my long-term strategy and buy consistently, but not aggressively, from a position of financial strength, bit by bit, and slowly creep up the size of my investments each and every year. And so I don't care if the market booms next year. That'd be really nice. If the market tanks next year, that means the year after I'll be able to buy at a little better value. And over 30 years, I believe Denver will produce a great return. You have to ask that same question for yourself about your market.
Yeah, and I think that's the most important thing that you brought up is it's your time horizon and how what your position is on your financial strength and I guess your financial stability and how much liquidity that you have at the current time. Because when you push it out, 30 years, absolutely, 100%. So, and I think with investing in general, that's a good way to look at it. Is the longer your time horizon, it's not a get rich quick scheme here. It's a cash flow scheme that creates passive income and generates a lot of wealth building over the long term. So, it's a good way to think about it, for sure.
That's great. So, I mean, one of the things that you talk about, I mean, the main purpose of this book is to achieve financial independence as early as possible in life. Can you kind of define exactly what financial independence means? And I know you define it in the book, comparing, you know, an NFL athlete to just an average person who just has a 9-to-5 salary. Could you kind of define what financial independence means? It doesn't necessarily mean, you know, Corvettes or Ferraris or anything like that.
Yeah, I mean, it's a moving target, right? If you're in college, financial independence is $200 in a case of natural light. If you're a 50-year-old person with kids in college, it could be $2.5 million and $100,000 in free cash flow. So the baseline is, once your assets generate enough income to meet your lifestyle needs, you are financially free. And so I think the key is to get on top of that and stay on top of that throughout life. You don't have to, like, once you jump out ahead, if you can get to $500,000 in net worth and $25,000 a year at age 23 as a single person, for example, or 25, I don't know, then you're never going to the way that compounding works and the way that your natural hustle and entrepreneurship and the opportunities that will meet you, over the course of your life will result in a reality where you're never falling below that line for any meaningful part of time, length of time for the rest of your life. So I think it's all about, that's why it's like kind of intentionally vague. And it's just like, how do you get to a couple $100,000 in real net worth and a couple $1,000s a month in passive income? And then it's up to you to figure out what that end state is, right? It's a moving target for me personally, right? Like, I just got married this year and we're thinking about starting a family. And so, the small amount of financial freedom that was sustaining me a few years ago would no longer fly. But again, I've kept up with that compounding phenomena along that continuum that is financial independence while I've been over the years. And I think I'll continue to do that. So it also gives a new meaning to frugality. I no longer live in a basement duplex that is a fixer-upper. I live in a nice apartment that I rent right now because I pay for it with passive income from my rental properties that I've acquired over the years, right? So there's a moving target on that as well.
Yeah, but the base is what allowed you to be able to do that, right? The frugality base is what allowed you to kind of be able to do what you're doing right now, which is great advice. So,
absolutely
awesome. So I wanted to keep it relatively short on the Q&A, or on our Luke and I asking you particular questions so we could open up to Q&A to the rest of the audience. So if you guys have any questions in particular, feel free to chime away. I'll be checking Facebook as well to see if anyone has any questions on the chat.
Congrats on getting married, by the way. That's
thank you.
That's an exciting time. I've got 2 little kids myself, and you're right. You're 100% right on your. It gets a lot more expensive.
Moving target.
Back when in the olden days, it was much cheaper, but that's awesome, man. Good times.
Scott, this is Jake. First of all, I've read your book, and Raphael, you were the one that recommended it to me. So shout out to you. You do owe him a beer, but there's somebody that's in that third bucket, right? That's developed the mentality, the frugality, has house hacked, and is trying to, once again, to go into a book you've recommended me to, Raphael, like When to Jump. Talk about processes. I know you're a process guy from everything I follow about you. What are those processes as a guy that's a little unique because you're a CEO, you're not an employee, but what processes can a full-time employee take on to set themselves up to be able to make that jump sooner and speed up that runway of financial independence? What do you implement into your day-to-day so that you can be consistent, but also put time to your job, be an effective employee? I don't know, just if you want to expand on that.
Are you saying you're currently an employee, you have a considerable length of time left in your employment as you see it, and you're kind of wondering what you can do to accelerate the journey to financial runway or financial freedom?
Yeah, and then what are the processes that you've built to be able to do that?
Yeah. So first, I would say, on the financial side, I think go back and just create that pie chart of expenses, right? And say, like, where are they and how do I attack them? And where can I be? Where are my real issues there? And can I fix those big fixed expenses in particular over time, right? That's not an overnight process. That's a year-long process. From there, I think you got to ask yourself at your career, like, do I like it? and what is the best case scenario if I map it out? And is that because there's two risks that you have when you talk about your career, right? One is what happens if I leave and don't make the same amount of income? What happens if I stay and fall way short of my potential? And so the gap between those two is something that I assess to be enormous, I think correctly for myself, but you're going to have to make that assessment as well, given the dynamics of your company and what you're working on as well, according to that. Then once you assess your wealth position, I think it's going to be about like, what kind of liquidity and options do you have, and what kind of skills do you have? Is there anything that is applicable to your situation, like a house hack that has a ridiculous ROI? And maybe it's not a house hack. Maybe it's a business or consulting or website thing that is very unique to your skill set or whatever. And then lastly, I think it's that entrepreneurship piece, if that falls out. Surrounding all of that is, I think, a process for goal setting. So do I have a 3 to 5 year vision? Do I have it mapped out? And you don't have to spend 2 weeks on your 3 to 5 year vision and get it perfect. You put something on a piece of paper, you revisit it every week and evolve it or whatever. And then you say, great, I'm going to back into a set of goals from that go into my 3 to 5 year plan, my 1 year plan, my quarterly plan, my weekly plan, and my daily to-dos. How's that for a long answer? Thank you, by the way, for reading the book and such a great question.
No, yeah, it's good. And I mean, that's the answer to that question is everyone's situation is unique, and you have to map out, calculate it, but also map out that opportunity cost, which I think is really where my question stemmed around is like, how do you measure opportunity costs and be able to build processes to one, determine that, and then two, make it so that once you do make the leap, you're able to pull your parachute, and you know how to do that, and the processes are in place to be able to build it on the way down.
Yeah, I think it comes back to financial runway. So like if you earn 80 grand a year or 100 grand, let's get 100 grand a year and spend 90, right? And then you take a job and you have $25,000 in the bank, and you take a job that pays 50, but has the potential to get you to 200 in 3 years, right? You have a huge risk, and that opportunity cost to risk is way out of whack. But if you spend 50 and have an emergency reserve of 50, then that opportunity to risk profile is very, like, I think clearly in balance with the $50,000 a year job with the $200,000 upside. So I think that's kind of the model I would use to think about that is it's all about, like, from the financial side, I think that's the model. From the upside piece, I think that you have to then maximize your chances of success if you are going to take that leap. And how do you do that? I think it's reading, right? I don't know how much experience you have in the new field or whatever it is, but like if you don't have any experience in the field that you're going into, but know that it's the right one, then the way to make up for that is brute force. You read 50 books, you may have 10 years more experience in your head than your competitors. And it might be fresher as well. So that would be the, how's that for helpful? Is that
spot on? Yeah, it's helpful. And I think that's everybody's question that's in this bucket of whether they read your book or not, and they're in that eliminated house hack or have done house hack and eliminated that expense, just still have the fear to overcome of jumping. And so
it's terrifying, but it's a lot less terrifying when you have the financial runway and the low savings rate. And then you just got to work it up. How do I get more terrified about my fate if I stay than my terrified of my fate if I leave? Right. And that has to be I don't know how to mathematically map that out. I just know that the inflection point comes faster as you build up more knowledge and build up more wealth, I think.
Certainly. I'll pause. I have tons more questions for you, but I'll let other people jump in here.
Those are great questions.
Yeah. So actually, Ben just reached out and he was asking, why do you choose to rent in Denver instead of owning the place you live?
Because the place I want to live is, it's in order to buy, like, for example, I live in a 4-unit building right now. I would estimate that to buy the complex would cost me $2 to $2.5 million, which is a lot of leverage. But I can rent it for 20. I can rent one of the very nice units for 2,400. So for me, it makes a lot more sense to live the lifestyle I want at 2,400 a month by paying rent, and then just instead of investing, even if I was just going to, even if I felt comfortable making the 500, plopping down $600,000 on this particular quadplex, I'd rather plop that same $600,000 down on a better cash flowing properties and then use the income from that to pay for my lifestyle. I would not start out my journey by doing this. I'm doing this because it's something that I feel that I have worked for 10 years, 7 of which I've house hacked during, in order to generate income so that I can live in this lifestyle, in this property. Also, rents did kind of come down a little bit for some of my properties in Denver this year. And so while I lose on the rent, on the landlording side, I'm winning as a renter. It's just way more. It was a great deal. I think I'd have to spend a lot more than $2,400 to have this lifestyle as an owner rather than a renter.
Awesome, man. All right. So Emily from Facebook. Hey, Emily. She's asking, would love to hear your thoughts on diversification of all assets. As you said, it's good to have gold, Bitcoin, counter cash. What would you recommend in real estate? Single family, multifamily, commercial, short-term rentals?
So this is going to say paradoxical. When you're starting out, I think diversification is kind of a lousy approach because if you want to achieve financial freedom early in life and bet on yourself, I think how about this? When I started my investing journey, I saved up 20 grand and then I bought a $240,000 duplex, which was like 4 to 5 times my annual income in terms of asset value. And I put all of my liquidity into the property and I put most of my time into fixing up the property. And that was everything, right? And so that was like, how could I possibly have diversified my money at that point in time to begin building wealth? Now I'm sitting here with I think a pretty sizable personal net worth. And so now I think that diversification begins to come into play. And that's where I've actually put more dollars into long-term index fund investments, which are an inherently diversified asset because you're investing in the entire stock market, the total stock market, than I have into real estate. But I have more asset value in real estate. So which one am I really diversified in, right? I'm trying to build up those positions across those things. But then even now I take all of that and shove it aside. And most of my net worth is invested in a company called BiggerPockets. Why? Because that is where I'm going to get the majority of the ROI as we build this brand and I pour my heart and soul and life into it. Right. So even now I'm still not diversified in a traditional sense. If I were to begin moving towards like a true state of no longer actively earning income, I would then begin the process of diversifying my assets and putting them into a spread of investments outside of just Denver real estate, just index funds, and just BiggerPockets. But for the time being, while I'm working hard, I actually don't really diversify that much. I diversify my cash position because it's much bigger than it needs to be. Because I feel like personally it would be kind of embarrassing to write a book called Set for Life and then go broke. So that's part of the reason why I have a larger cash position. But
yeah, and it wasn't Andrew Carnegie who said that you put all your eggs in one basket and just watch that basket. Yeah. So it's kind of an interesting concept right there. All right, let's see. Does anyone else have any other questions? Probably have enough time for 1 or 2 more.
I have one. Sure. Also, I read the book. It was recommended to me by Jake, who you talked to a second ago.
It's like a 6-pack now.
I guess my question is, so I'm kind of in the between phase 2 and 3. So I have a house hack and I've kind of followed a lot of the steps. What do you like? Do you have any recommendations for things to be doing during periods of low liquidity? Right. Cause when I bought my house, like it was pretty much, I was fresh out of college. So like, it's like I'm rebuilding that runway now, but I also feel like I'm just doing nothing, like, cause I'm going to work, but that's it. So.
Yeah, no, I think, my story was that I was able to, because of the growth rate of BiggerPockets and joining this kind of explosive startup, I was able to pour most of my energy into building my skill set specific to that. Sounds like that's not your situation where perhaps, well, you tell me, do you believe that if you poured yourself into reading 50 books, that would have a meaningful impact on your income in your current profession?
Yeah, I would say so. I also do a lot of, I read pretty like a lot already. So
Okay, then I have this to say. So it sounds like you're doing all the right things, and what's happening is you're building wealth at a pretty good clip. You're just spending less than you earn. You're house hacking. You're getting a wealth appreciation, and you're just rebuilding a liquidity position. And so I guess my advice then would be that feeling that you have that it's boring, that it's automated, that it's just kind of continuing. That is the feeling of getting rich. And so you are in the process of it, and you're doing it right, and it should be that boring and that simple and like, what the heck, is there more to it than this? No. If you feel like you're optimized on the income front and doing the things you need to do to grow, you have a solid savings rate, and you're just kind of like slightly like, what is this? Is there anything else? You're doing it right. So I think that could be where you're at.
Awesome. So I'll ask, I think there's enough time for one more question. And actually there are two questions, one from Jessica and Grace, but they're pretty similar. So I thought I'd kind of play off of Jessica's question. So Jessica says, my financial advisor says I'm sitting on too much cash. It's probably a year or more of my living expenses. What would you recommend to put the extra cash in? She likes to burr, so she doesn't necessarily need a down payment for money for deals. So I guess the general question is, if you have some cash right now, what can you do? Do you think that the burr is a good situation, or I guess I'll let you take that from there.
All right, so maybe completely contradict myself from earlier. So as you're building your position, and you have you don't have any cash, and you don't have any of that runway or whatever, I think it's critical to get that runway so you can bet on yourself and make these investments like house hacks and real estate investments, and build that wealth that gives you life options today rather than in 60 years or whatever. When you have too much cash, I think it's time to dump out to play the retirement account maximization game, because that's how you can begin to defer income and play a lot of games there. So I would recommend getting on the call with a financial advisor or CPA and figuring out, how do I max out my 401k? Can I do a Can I do a backdoor Roth? Can I do a mega backdoor Roth? Can I play games around those types of things? If I'm truly just have so much cash and I'm going to invest it for the very long term, those are the types of things I'd begin thinking about, and things that I'm beginning to think about now that I have this great problem alongside you, where I have more cash than time to actively deploy it in my private real estate portfolio or those other types of things.
Definitely. And you do elaborate a little bit on that on the back at the end of your book. So definitely worth checking out if you do get an opportunity.
It's a great thing about appendixes. Q&A is kind of like a big appendix, right? So,
yeah.
There we go.
No,
Perfect.
I mean, oh man. And really, I mean, Luke, did you have any other questions or anything?
We just really appreciate Scott, you coming on and taking the time out of your day. We look up to what y'all are doing over there at BiggerPockets, and we think you're doing a great job. We can tell that you're pouring your heart and soul into the business over there, and we all benefit from it. So we're all very appreciative, and thank you so much.
Well, thank you, Luke. Thank you, Raphael, and thank you to the Jakes for your great questions.
No, well, thanks again so much, guys. We'll go ahead and wrap this up. We're coming up on 7 p.m., but thanks again for tuning in, and we'll see you guys next time.
Bye, guys.
See you guys.
Raphael, thanks for hosting.
Thank you.
Oh, of course.
Yeah, thank you.
See you guys.